Good afternoon, everybody watching this webinar. The agenda for today is going to start, as you might have expected, our guests with about the trade war and a few reflections from us on that. Then we'll move on and talk about the portfolio. We're going to run through an investment case from the fund before wrapping it up and taking any Q&A toward the end. So with that, the trade war here. So it was obviously a pretty big bounce yesterday here about a question that we hear is, is it time to sell all American stocks? And we don't think so. We think it would be premature to make that conclusion. And there are, of course, many aspects that can be discussed. Today, we want to focus on a couple of them. And the primary one being why we think that the trade war is not gonna drag on for years and years. If we kind of turn back the clock to the presidential elections in the US in 2024, Trump and the Republican Party, they won a pretty strong mandate. They controlled the presidency, both chambers of Congress. And in our view, what made Trump win all 7 swing states was the fact that swing voters thought that Trump and the Republicans would do a better job to bring down inflation compared to Biden. So we can see it as that was the mandate that he was given by the majority of the voters. Now, we don't think that these voters supported throwing on tariffs onto the neighbors in Canada or Mexico, messing with the Panama Canal or Greenland and so forth. So if that's what the administration is going to focus on, which is probably or very likely going to be an inflationary policy, then that's going to mean trouble in the fall of 2026. Because what happens then? Well, you have what's called the midterm elections in the US, and that's not yet widely discussed in the media. But what's going to happen is that you're going to have the whole House of Representatives and about 1/3 of the Senate being up for re-election. Now, if Trump has not turned the economy around, we believe that there's a big risk that he's going to lose the relatively slim majority that he enjoys currently in the House of Representatives. And if that were to happen, that the Democrats would take control of the House of Representatives, it's going to make it much, much more difficult for Trump to pursue his political agenda in the coming or the final 2 years. So whether this is going to impact Trump himself, can't really tell, but we think there are certainly a lot of people around him who think about this, which means that the trade war rhetoric may be bombastic as a negotiation tactic right now. It may go on for a little bit, but at some point we think cooler heads are going to prevail, and then you will maybe tone down this whole tariff thing and more move toward lower taxes, deregulation to get the economy humming again well before the midterms take place. So that's, of course, by no means a guarantee that that's going to happen, but we think that there's logic in that reasoning, and it sort of is our base case, if you will, sort of on a macro level. Now, another question that we get sometimes, if there's going to be a recession in the US, maybe driven by higher tariffs, does that mean that all American companies should be sold out? And once again, we think here it would be premature to draw that conclusion, because many American companies, they may be American in the sense that they have a headquarters in the US, they trade on the US stock exchanges, but as we have talked about in the past, to us what's important is where do the revenues come from? So if you look at these two well-known brands on the screen, we own both of them, by the way, in SKAGEN Global, and you ask yourself as a quiz, what percentage of the revenue do you think come from the US and what percentage from outside of the US? And as the answer, which is coming here, shows you, Microsoft is essentially a 50-50 US, non-US. In the case of MasterCard, 3/5 or 60% of the sales sort of come from non-US markets. So it's not clear to us in any way that a US recession would automatically be worse for these companies than for some other ones. Actually, they may even hold up better than other companies. So that's sort of the second thing to think about. And the third, which is what we focus on mostly as SKAGEN Global, is of course that you have to analyze, assess, and think about each company individually. Now, of course, we take into account the macro environment, the context in which the companies operate, but we spend most of our time analyzing each of these individual companies. And those of you who have been with us for a while, you've seen this page before. I mean, this slide kind of outlines in a simplified way some of the cornerstones of the investment framework. Looking at kind of the companies we seek, they should have attractive long-term fundamentals, a clear competitive edge, solid financials with a balance sheet that is strong, clear cash flow generation. We need management to be both competent, trustworthy, have integrity, and on top of this, of course, anything we were to buy has to be undervalued. Almost goes without saying. In kind of these uncertain times, I mean, one aspect that we would like to sort of highlight a little bit more is just the importance of having a competitive advantage. And to illustrate what we mean by that, these are companies that you can see here, or sectors where we think that the companies have a distinct competitive edge. These would be, for example, firms that own landfills, railways, so railways being for freight railways, exchange operators. It may not be the most exciting areas, but over time, owning some of these assets is an excellent way to build value and sort of stay ahead of any type of inflation, erosion of purchasing power. So you will find a number of these in SKAGEN Global. And again, very hard to compete with these ones, which is important when the times get tough. With that, we'll move on then to the portfolio and kind of see how the fund has started the year. As you can see on this slide, showing you the returns in the gross returns in euro, it's been a good start for the fund. The fund is roughly 5% ahead of the benchmark at the end of the first quarter. We'll go on and look at the individual holdings that have been good contributors to the performance. And then we have a little bit of ground to make up for the past few years, but we think we're on the right path and kind of happy about how things look currently. Then if we dive deeper into the individual holdings, here are the top three and the bottom three contributors during the first quarter. We have on the plus side Munich Re, which is the world's largest reinsurance company. So German-based, very well reserved, a lot of capital. We expect them to do well in an uncertain world, and they have certainly lived up to our expectations. Second one is TMX Group, which is not as well known, but this is a Toronto Stock Exchange operator. My colleague Chris Tommy and we went there in last summer to attend the Capital Markets Day. We were impressed by what we saw, spoke to a lot of the staff from the company, and think that there's a compelling underlying story that can play out over multiple years in TMX, and is off to a good start. Lastly, then on the top side, Brown & Brown, family-owned insurance brokerage firm, They also tend to do well in this type of environment since they are only a middleman. They don't have any real tangible exposure to the underwriting, and capital light business model, very well managed overall. Then I mean to also highlight the ones that have been lagging so far this year in the fund. You will probably know that the big tech companies have had a tough start, even though they had a bit of a comeback yesterday when the market took a big jump. But the ones that we own of these magnificent 7 stocks, so we own Google, we own Amazon, we also own Microsoft, but Google and Amazon, they have performed worse, so the ones that we have so far in 2025. And then also Canadian Pacific, the railway company, is off to been struggling a little bit, and that's as expected. This is part of the cyclical side of the portfolio, and with the tariff talk and both against Canada, but also maybe reducing freight coming in to the North American continent from Asia or Europe, that's one that we would expect to be a little bit weaker until the dust settles. Then if we look at the changes that we have done so far in the portfolio, let's go start by seeing what has been leaving the fund and what has been coming into the fund. Nothing has been exited during Q1, but we have entered into waste management. It's a name that we have owned in the past. North America's largest company when it comes to waste collection and landfills. What we like here, what has been a change compared to last time we owned them, is that we have had the Republicans take control. We think they are going to be more pro-business and allow waste management to make some targeted bolt-on acquisitions in the core business, something that was less likely to be allowed under the Democratic administration in the US. We've also seen them continue to deliver solidly on the base operations. And the third positive thing we have seen is that the integration they made, or the acquisition they made last year, they seem to have a good grip on how to continue to integrate that asset. So we actually see quite a bit of upside in this name, and it's been a good sort of addition to the fund. I also want to mention that when we kind of think about what has been done in the portfolio, even though you don't see any other logotypes on this slide, we have been making some internal adjustments on the position sizes. One example is Microsoft, as you may or may not remember from the webinar we held last April or last spring. We mentioned that in February 2024, we sold down our stake in Microsoft substantially because we thought valuation was getting a little bit stretched. That turned out to be the right decision, given that Microsoft has been trending downwards sort of since the first half of 2024. But at this point, we believe that the investment case is beginning to look more attractive because there is more upside now than in the past. So as we normally do, when we see more upside in a case, then it's natural for us to add to the position. So we have been adding some to Microsoft as one example. There are also other examples where we have shaved off a little bit from the well-performing, more defensive positions and recycled that capital into those names that have been seeing what we think is a bit of an excessive sell-off in a few cases. So that's kind of where we stand by the end of Q1. And if we then look at the top 10 list, here you see it with the 10 positions, sizes, some key financial figures. Two things to highlight here. First one, if I kind of draw your attention to these financial kind of key parameters, net debt to EBITDA or interest coverage. I mean, they are both two ways in which you can assess the strengths of the balance sheet, and We talked before about that SKAGEN Global places a lot of emphasis on having strong balance sheets in the companies in the fund. And indeed, in both cases, SKAGEN Global as a whole has better, also more strength in their balance sheets compared to the average company in the index. So it purely reflects quantitatively what we say that we are looking for in qualitative terms. The other part on this slide to notice is here the upside that we see in the fund. This is over the next 2 to 3 years, closer to 3 than 2 years. This was by the end of March, and the market has been coming down a little bit since then. So today the upside would be a few percentage points higher than what you see here. So we often talk about that we aspire to sort of deliver a kind of return, kind of 10 to 15% in that range over time. It's an aspirational goal, and if we can kind of reach these upsides, that would sort of parallel or be a good indicator that we are on the valuation side where we would expect the portfolio to be. Then sort of another name, and should kind of mention here, Abbott Laboratories, one of the larger positions in the fund, around 6%, is the investment case we would like to say a few more words about today. And we're gonna zoom in a little bit on this picture up here, which is something you have seen probably on people, and you may or may not know that this little white thing here is essentially a glucose reader, so that you can monitor continuously your glucose, meaning your blood sugar levels, and then by just tapping it or holding your phone next to it, you can automatically see what the value is on your screen. And that's kind of one part of the Abbott case, and we'll say a few more words about it soon. But before then, just to give you a feel for what is Abbott Laboratories, they are a medical devices or medical technology company. They produce things that you can see here, primarily heart valves, pacemakers, stents, different machines for analyzing blood lipids, and of course also the diabetes care. And just to be very clear, they don't produce insulin, they don't produce or sell diabetes medicine. It is the monitoring devices, which is what Abbott focuses on. Okay. Now, as you may recall from our simplified investment framework, we talked about the importance of having a solid fundamental backdrop, and we think diabetes certainly ticks that box. Here you can kind of see the number of people across the world who have been diagnosed with diabetes, more than 500 million by 2021, and the number is steadily ticking up. So there's certainly a big market, a lot of people who could benefit from treatment here over many years looking forward. It's also good sometimes to look backwards and just to kind of see what has the history been, and here are some of the milestones in the development and treatment of diabetes. About 100 years ago, you had the first discovery of insulin, which was revolutionizing in itself. And then you had, in 1964, the first sort of insulin pump being developed. Now, as you might guess, this was never a big success, given that the whole pump is the backpack, so it was pretty inconvenient to walk around with it all the time. But it was a good idea, and of course it has been refined, and as you can see, sort of things have shrunk in size. And since 2017, we have this glucose monitor without the need to do finger sticks that has been developed and championed by, for example, Abbott Laboratories. So here you have it again as a close-up with this device, smallest, thinnest, most discreet, real-time reading, something that is obviously very, very helpful for diabetes patients. but it doesn't take that much imagination to see that it could potentially in the future also be used to measure a number of other substances in the bloodstream. So here there is some option value we think that could play out over the next years and maybe even decades. Okay, so kind of going back then to the stock price, what's happening there? Well, since for 2015, 2016 has been a kind of a good rise for the stock, but if we look at the last or the past kind of 2, 3, 4 years, it has been rather stagnant, sort of here treading water around the $100 mark or so. And the question is, of course, why has this been the case, and what would lead to a change? Well, if we look at then the sales from Abbott over time, here you can see the annual sales by the company. If we look at the overall sales, so on a group level from 2021 and onwards, it has been also pretty stagnant, not a big movement upward, but pretty much kind of around this 40 billion mark. And that may be why the market has been skeptical on the stock and not willing to pay up for it. That's one way of looking at it, but as SKAGEN Global, we look at this graph in a different way. Because if you look here from 2020 and onwards, these yellow parts of the bar, they represent something that happened during these years. It was, as you may guess, the pandemic, the COVID years. And Abbott was world leading in developing these rapid COVID-19 tests and earned several $1 billion annually for this. Now, from our point of view, this was never going to be a large sustainable income stream. It was always in our minds something that was going to be for a few years at most. And we see it purely as a temporary cash bonus into the company that can be used to fund R&D or capital investment decisions. So what we look at when we look at this graph, we look primarily at the blue portion of the bar, which you can see has been growing actually steadily here over this time period. And that gives us confidence that the company can grow as we look out the next few years. Now, the market hadn't really thought about it this way until the end of 2024. Now in 2025, of course, we're only a few months into it, but it seems that maybe now the market is beginning to appreciate that the base business has been growing and can continue to grow, and the stock has moved upwards, but we think that there's a lot more to go for in this name, so we're not finished yet here. And just kind of on the final note, as you may remember, we also talked about the importance of balance sheet strength and so forth. And Abbott, they have a very low degree of leverage on the balance sheet, so that's positive. They have also been paying a dividend for more than 100 years. Okay, so since 1924, Abbott has been paying dividends, and we think that there's a high likelihood that they can continue to do so for many, many years into the future. So that kind of tells you a little bit about Abbott Laboratories. And with that, we wanted to kind of wrap up where we are by making a few final points. First one just being that, okay, there is uncertainty now with Trump, with the trade war. There's some geopolitical tension in the world. But if you look back to say, like this graph shows you a different crisis going back to 1987, this is not the first time there's been a crisis or a big uncertainty. It's not going to be the last time. But what is remarkable is that the global equity market has continued to kind of grind upwards through all of these crises. Of course, it doesn't go in a linear fashion. There will be dips up sometimes, but so far we think that this crisis is currently ongoing, that there's every chance that we will overcome it and come out, in a higher position here over the next few years. Again, we don't know how things are going to develop with Trump, what's going to be the next tweet, what's going to be the next sector, company, or geography targeted. But what we do know is that we have compiled a fund which is diversified, but also has a few carefully selected holdings. We have around 30 names in the fund, and they have exposure across the globe. They are well run, they are well capitalized, and we believe that they can help the fund navigate this complex environment and hopefully deliver a good return in a number of different macro scenarios. So, key messages from today. Number one, SKAGEN Global, 5% outperformance in Q1. Number two, we don't know what's going to happen with the trade wars or with Trump for that matter. So we work under the motto to prepare, but don't try to predict. And we have prepared by, as you can see in the third bullet, putting together a portfolio which is resilient and is attractively valued, what we think is a high risk-adjusted return upside if you're a long-term investor and you can sit through some of these short-term fluctuations that will happen from time to time in the market. And of course, they can be pretty deep valleys at some point in time, but we are not concerned from our point of view. So with that, then we are ready to hand it back to our moderator Ole Christian here, and with the final words that we have a strategy, we follow it, we think about getting rich slow is a very suitable strategy in these type of uncertain markets.